Well, welcome to the Challenger podcast. It's been a while. I'm your co-host, Zack Miller, Tearsheet's editor-in-chief. I'm joined by Josh. Josh, want to introduce yourself?
Hi, everybody. Josh Liggett, our crowd. Zack, been a long time.
It has been. We just checked before the show. It's episode 16 of the Challenger Bank podcast. Last time we spoke about this subject was August 2020.
Bit of a different world back then. No one knew what an NFT was. SPACs were really interesting. What else is going on?
Foreign challenger banks were there was an excitement about them breaking into the U.S. market.
Yeah, it was the next great hope.
So a lot of that has changed. I guess part of this episode will be catching up, I guess, where we left off. How does that sound?
That sounds good. And then get into more fun stuff.
So let's start with N26. They were in the FT recently, an interview with one of the founders, and the headline was something about them getting it wrong on global expansion and crypto. So this is interesting. N26, at the same time as Revolut, two of the biggest European players decide a couple years ago that they're gonna penetrate the U.S. market. Big plans, though not very big plans. When asked for specifics back then, I remember reporting and talking about them here on the podcast with you, Josh. There wasn't a lot of marketing. There weren't a lot of marketing dollars allocated to these their launches in the U.S., and there wasn't a lot of thought around differentiation. I know you and I had spoken about that a couple of years ago.
We also, if you recall, they also went after Brazil, which was hilarious because there's this thing called Nubank, which I don't know if you ever heard of, which is
it might be the biggest challenger bank in the world, right?
Yeah, and pretty entrenched and coming into a market that was underserved and needed a new bank, no pun intended, or pun intended, whatever you want. And they came in and said, "Hey, we're going to go into your backyard and beat you at your game," which doesn't seem like it worked out too well. And not the greatest of decisions. But it's just interesting. Like, I think I see this in the startup world all the time, and I'm sure you see it, in the world, that you can't just flip a switch and switch regions, and like you can't just say,
There's not a global playbook, right? A singular global playbook.
Yeah, even like in the US and going different states, it could be nuanced. Even totally. Like to go from Europe to, the US is two totally different things. To be in Asia and to go from one Asian country to another, two totally different things. And just board meetings are going to say, the board members are going to say, "Hey, we're just going to go to the US, no problem. Everything's going to be great." And then, push comes to shove. It's a lot more difficult, and you can't just. You have to think, double whatever you think you're going to do, double everything, all the costs and all the, the growth, half everything. And that's just what happened, basically.
So we've seen N26 actually subsequently retreat from the U.S. market. Revolut still seems interested in tackling the U.S. market. One of the things in this article that the N26 co-founder had said was, wow, we could use that time instead of global expansion, really focusing on building our core products better and including crypto. And in this time period where N26 kind of went on a global expansion, it didn't really focus on this whole new market that was arising, and feels a little bit late to the game. One thing I should also say, this article also points out that N26 last year, there was sort of a dubious veil cast over what had gone on in Germany. BaFin, the local regulator, is limiting now N26 from opening up accounts to 50,000 a month. And if you do the numbers, N26 had been opening up about 170,000 accounts a month. So this was handcuffs. This had to do something to do with we still don't have a lot of details on it, with anti-money laundering protocols. So something went down there, and the German regulator is saying, "Hey, we're going to hold the reins a little bit tighter on N26." N26 gearing up to do an IPO, and they just did a huge round of fundraising, but it's only worth a third of what Revolut is, and so there's something about whatever went on behind the scenes, I think, that's holding this company back. Maybe that's a good thing.
Maybe it could be a good thing just to, slow down. I don't know. But going back to what you said about, crypto, now is this week is probably a bad week to talk about, man, we should have done crypto after what's going on in the markets. And and what the people, all the FUD that's going on in the crypto markets and the overall markets in general. But I mean, you could have seen probably 2 years ago, that there was a lot of hype getting into the crypto markets. I don't think Elon was I don't know, we have to go back and when Elon started talking about, Dogecoin and the Shiba Inu and all that stuff, and getting all the Wall Street bets guys pivoting from, all the retail side of being into GameStop and moving into the crypto markets because it's just the Wild West in there. But it was just the concept of, well, maybe it shouldn't have been crypto, but the idea of, like you said, focusing on our core business before we go out and expand. It just makes so much more sense. And, not to have any spoilers, but who we're going to talk about next, I think did the opposite of that and is really focused on building their core business out, and then said, hey, now we got this together. Let's go and expand out and move over the world. And I think that's just more a successful way of building out a startup or a business.
I agree with that. And I know that was something that you used to harp on, when a lot of the challenger banks were launching new colored cards, new metals in terms of the composites. You were talking about unit economics, and no one seemed to be talking about unit economics. They were more concerned about the colors. But I think the world has matured, obviously, since then. There was some euphoric, maybe wishful thinking around some of these things. But, now these banks or at least challenger banks may not have a full license, but they're thinking about building a real business now, especially as they think about going public.
Yeah. And especially now, like with the markets, are they going to be tolerated? How long are we tolerate, the lack of positive unit economics? We've seen with a few fintech stocks out there, that there's been, the market is starting to say, okay, we need to start seeing something. So in terms of a path, like not just a bridge or
let's see a plan. Let's see a real plan.
We're going to get to positive unit economics, net profitability. It seems like people are starting to say, okay, you need to start getting your acts together, but who knows, it could go on for longer. This could be just the flavor of the month of January, just being bad. And then February back to business as normal and everything's great. But that's what it looks like right now. And that's what a lot of people in the industry have been talking about.
So I want to shift a little bit to Starling. I think that was who you were alluding to before.
Absolutely.
So Starling, UK challenger bank, very decidedly had said years ago, we're really focused on our domestic market. We're going to get it right here as we figure things out, and we're going to get profitable. And that might have to do with Ann Bodden and her traditional banking background. She wasn't really drinking the Kool-Aid in the same way that some of these other guys were. And now it seems that as Ann and co have plotted out a path towards profitability, they're going to be getting into the platform business as banking as a service business, which as a technology company seems to make a lot of sense. Have you seen other companies do this, Josh? Is this like a tried and true path?
I mean, if you look at their path, which is really cool. I like that they have on their website the road to Starling, which is really interesting about how they built it. They built it like very thoughtfully. They started initially having some customers, but they got their banking license pretty early, if not mistaken. And I think they were also one of the first to get their banking license, in a long time in the UK. If I'm not, correct me if I'm wrong. I think that was them. And it was just it was a very thoughtful process of how they built the business, and they didn't build a startup. They built a business, and it could be that some people, some people would rather have that explosive growth and those quick, trying to get to
as high numbers,
the
bragging rights,
the PR numbers, all those things. But they built a very solid business, and all now suddenly, 5-6 years down the road, they're in a great position. And, Ann's done an incredible job as CEO of the company of building this thing out. And they're just eating everyone's lunch. What it seems like they're getting pretty close to profitability. I saw from their revenues were increased like 500% or something like that. And they had 5x growth in so many different KPIs. They're just doing a really good job. And that's not even the 2022 numbers, which that was like the 2020-21 numbers, not the 21-22 numbers, which will come out in, I think, 6 months or so. But yeah, they've just done an incredible job, and they're going global now. They're just going to be able to be offering more and more. And so it's going to be interesting to see if they can execute, because again, it's not a shoo-in. Regulations are totally different. They're going to have to get everything together. They're going to have to really do it correctly. But the way it seems like, they've done a really good job up until now.
What's interesting to me is also a lot of it makes sense if you're building a digital bank eventually to spin off. And as a platform business, as a software business, I actually should take a step back. Does it make sense? Because they are two totally different businesses. Just because you can doesn't mean you should, I think. We're seeing a lot of new competitors, certainly at Tearsheet and in our coverage over the past 18 months. We've seen a lot of new competitors move into the banking as a service or what we call embedded finance space as the platforms themselves behind the scenes. What differentiates, Starling from some of the other players out there, other than the fact that they know how to run a good bank, which is probably a good start. So one thing I should say is if you look at what Goldman did, and maybe we can move into the Goldman story with Marcus. You're talking about also when I talk about Goldman, I talk about as the only top 100 bank, maybe the only bank that I can think of offhand that has undergone what we talk about as like transformation. This is a bank that changed business units, it changed its customers. I don't know if it'll work, but what it is working in sense of what it's targeted in terms of becoming a retail bank. They've got millions of customers now. They've expanded into multiple geographies. Marcus itself also has launched an embedded finance platform, a transactional banking platform that works with customers all over the world. This is to me the poster boy of what transformation can do, but it does require you look at the Marcus results. Even though it's doing really well, Goldman Sachs has not successfully changed its business line enough that it looks like that's really working. I don't know if you could say that financially, at least.
Yeah, well, Goldman's also they're still doing their normal business, which is so big, it's hard to sort of make a dent into that, right?
Yeah, well, trading and investment banking is still totally dwarfs the other things, but retail banking in the way J.P. Morgan has created it. Can retail banking become the core of Goldman Sachs financially?
That'd be funny if it did. Yeah. I mean, because it's like when I was in college, I'm sure when you're, back in school, you're thinking about a Goldman Sachs, last thing thinking about is retail.
Yeah.
It's like the total opposite.
White shoes, the white shoes.
Exactly.
Business. Yeah.
Exactly. Like investment banking, you think of, analysts coming out and working those 40-hour, days, whatever you want to call it. But it's interesting that there's the whole thing of a lot of the Goldman credit cards they've been doing in the consumer stuff. It's, it's funny because a lot of it came out of buying, they bought us a credit card, acquisition.
Capital.
Yeah. And they also, from Final a couple of years ago, they bought them. They bought a few other guys and GE, GM. I mean, the stuff they've been doing. There's a trend they've been doing for a while of saying, hey, why don't we go and start being sort of like the back end for a lot of cards, like they did, as we discussed at length, the Apple Card and all the fun stuff that went along with the Apple Card, and now GM and all the stuff they're doing. It's really interesting. It's what it reminds me of a little bit when you see that is like when Visa was supposed to buy Plaid. When we got all excited about that because we love Plaid, but just and just APIs and now MX just coming in and doing all the stuff. But it was we spoke about how cool Plaid was and what would it do for business, and we looked at their revenues versus the valuation of Visa. It's nothing. It's absolutely, it means absolutely nothing to the overall bottom line. So it's something cool that it'd be interesting if they're able to build it up over time and sort of, because people would feel more comfortable with a name like Goldman Sachs as opposed to another startup. Maybe, but I still think it'll be something else, not necessarily their main source of business. I find that hard to imagine just because everything else is so big.
So what Josh is alluding to was Goldman Sachs, and we wrote about this at Tearsheet as well, launched their second branded card partnership. The first one was with Apple. This one's with GM. They'll be getting the GM card portfolio and launching a new rewards card, totally digital. It's a pretty cool product and some pretty neat, sort of digital onboarding tools that they use there. It also means that I think there were 6 million GM customers. I think they were part of this, and Goldman Sachs will get access to, to open accounts, banking accounts with each one of them. So this is the second branded partnership that Goldman has in the card space. And it also points to Goldman's strategy, which is the DTC business, the direct to consumer, as well as partnering with leading brands like the Amazons and the Walmarts and the JetBlues, the Apples, and now the GMs. And as sort of, it's it's very clear from the beginning that they were going to go direct to the consumer as well as through these partnerships. I think that makes a lot of sense. And I think they were smart in looking at the market and say, wow, we are Goldman Sachs, but it's still really hard to acquire customers. Why not do it through these partnerships?
Yeah. And you're doubling down on someone else, on brand loyalty that's been built by marketing dollars, by God knows what GM's marketing dollars spend to acquire all those people like together. So, I mean, was it 2.5 billion? I don't know. It could be. I could imagine it being more. I really could, over like the years to acquire all those different. Yeah, like or to So they're just, hey, we'll back. It's like we'll back you. Sure, we don't care.
It does require them not saying as a brand itself that we don't need to be in the front. We're okay being even white labeled, because if you look at the Apple Card, there's not a lot of mention of any Goldman Sachs activity around that product. So how many banks could do that?
But other than I think many of the listeners don't really understand this, but the people who aren't necessarily finance people. How many non-finance people could tell you at IPO who's the underlying investment
underwriter? Yeah.
Yeah. How many? None.
Don't know. Unless you work in the industry, you don't really know.
Exactly. Yeah. You don't care. What I care more about, when Robinhood goes public, the retail traders are more pissed off that they couldn't get into the IPO, not who did the IPO. They're more, they don't know who it is. So if you think about from the overall consumer, Goldman's always been in the background. It's been this sort of this Wizard of Oz structure that people think they know what investment banking is, which is classic. People who are in finance don't really understand what investment banking is. They've been a bunch of memes about that over the years. It's this thing that these guys just make a lot of money doing stuff. That's
deals,
what
they make deals. They do deals.
Yeah, not even the deals. They talk to people. I don't know. They make PowerPoints. But if you're in the industry, you know exactly what they do and you understand how important it is and where everything fits in. But so to say they're going to be in the back for credit card issuing, same difference as before. I don't think that's so. I don't think that's so crazy.
I think it's different for a retail bank when the brand itself is so primary and valuable to the customer relationship. It is a little different, B2B versus B2C. But anyway, so a couple more things I'd like to talk about with you, Josh, before we go this week. Revolut launches stock trading in the U.S. Does that excite you?
The 47th option for stock trading in the U.S. Cool.
True. Yeah. It does show at least that they're thinking about the U.S. market and still committed to it. And this is a trend that we've seen, in embedded finance for most of the consumer facing apps moving into stock trading, as you're describing. It's just another option here.
Yeah.
Yeah.
They're just trying. Listen, it's just trying to get more dollars. They're just trying to get people to deposit
make that
their money
stickier. Yeah.
That's all it is. So cool.
Acorn scrapped its $2.2 billion SPAC.
Not too surprising.
No, SPACs are just a disaster, huh?
Crazy. Totally nuts. IPOs also. It's blood, not a full bloodbath, but it's pretty ugly out there.
Yeah, we posted a chart, I don't think this past week, but the week before, about stock price movement, either post-SPAC or post-IPO, and most of them are negative. And it looks pretty ugly.
It depends. If you look at different verticals, I think a lot of the stuff in the autonomous driving is just getting hammered. That's one market I know that was getting totally crushed in this SPAC space, because you're talking about stuff that's got long-term revenue, private companies that are not public, and now the public market say, wait a minute, this is what's going on. It's a little complicated.
So is it a statement about SPACs themselves that maybe immature companies are coming to market, or they're coming to market too early? Is there something about the vehicle itself, or is it just that the market is horrible right now?
To me, it was that you just had this crazy trend, this just madness of people just with so much money to spend. If you look at what's happening in the VC world right now, in valuations, there's so much money. There's multiple funds with $10 billion, not one. There's you can probably 5 or 10 different funds that are doing early stage investing that have so much money to spend. They got to put the money somewhere, and you have these SPACs that got created that need to deploy. They just had to, because there's there's a time bomb on them. You have to by a certain point you have to deploy. So they just did it because they thought, hey, I want to put my money somewhere. Maybe I'll just stick it at this sort of long-term bet. And there was a shortage of companies and valuations just got crazy, and now there's sort of a bit of a reckoning. But there's still, the funny thing is that deals are still going to get done, and there's still value. It's just, I think you still have a good.
These are good companies.
You still have good companies. They're going to do fine. Like there's like a overall fear, I think, in the market that like, oh my God, everything's going to tighten up, everything's going to be crazy. It's like good companies are still going to do great, still raise money, are still going to perform well on the market. You may have a correction just overall in the market just because of, I'm not an economist. You're more, Zach. You can give your thoughts on that, like of the Fed's been doing.
My undergrad economic degree will definitely give me some authority.
We'll call Janet and see what she has to say about it, and Alan and everybody. But like the overall what's been going on with the market, and who knows what's going to happen over the next 6 months. But it's, there's probably going to be a correction, but that doesn't mean that good companies are going to have good value over time.
Got it. SoFi just cleared the final regulatory hurdle to become a bank. So that looks like that's happening. That's interesting. SoFi, sort of first generation challenger bank, I would call it, with roots in lending. Also bought Galileo, the biggest, banking as a service platform out there. Sort of the jewel in the crown, I think. Gets a banking license. I think there might be some interesting stuff that tie up continues to go. I know their numbers are still really aggressive for this coming year in terms of their growth. Galileo does touch most of the top fintech firms that launch. If they're launching a card, Galileo is involved somewhere along the way. So that's interesting.
Do you think this is just so they could have a better bottom line in terms of gross margin because they don't have to piggyback on other people, or you think it's going to be there's other reasons that make this, why they just decided to become a bank finally?
Well, I think the economics are much better when you're a bank, obviously, in terms of capital and cost of capital and permanent sources of funds. I think there might be something interesting with the tie-up with Galileo, that Galileo can use SoFi as its partner bank. I think there could be some interesting both technological and business outcomes by doing that. I think ultimately, if you want to get serious about being a bank, you have to be a lender along the way. So having your own license enables you to do that. One more thing I wanted to touch on with you, Josh, before we go this week was this article by Tom Noyes on how BNPL will involve buy now, pay later. I know this is something you and I have been discussing, over the past few months in our conversations.
First of all,
a couple years ago.
Let me give you credit because part of my anti-portfolio of companies I passed on is this company on the Australian Stock Exchange called Split It, which basically buy now, pay later on top of credit cards. And you were telling me about how interesting it was and how it's a layer of finance. 2016, 2017. Yeah. So I thought you were crazy, and I was wrong. And part of my anti-portfolio, it would have been a couple of, a nice little return on that. So yeah, you were way ahead of it on this one. So I got to give you kudos on that.
Well, so I appreciate your honesty about that. What it sounds like also you're open enough to. Can you talk about what you got wrong or what you didn't see then that maybe I missed it?
Well, I live in Israel.
Not as a way to rub it in, Josh, but as an economic,
I live in Israel. And in every single card company in Israel, when you go to the checkout of anywhere, asks you if you want to have, how many payments? Do you want one payment? Do you want 2, 12 payments? Every single, they've had this in Israel for how long? I don't even know.
30 years, maybe?
Something like that. Yeah. They've had it forever. So someone from Israel comes out with this idea, and we're like, come on. Visa could just do it. You know what? MasterCard could just do it. An issuing bank could just do it. This isn't really a big deal. They do it here already. It just didn't seem innovative enough. And apparently they could be a standalone business, and it's something, it's a layer. That's sort of what I went into it. And then when a firm started coming out and sort of doing it the way a firm's been doing it, which I think is very different than the way Split It did it, which is super important. And I think that's sort of what the article was talking about. But the way a firm has done it is a lot different. Once a firm started getting traction, I was like, oh, okay, this is actually much more interesting than that. And that's why a firm's got 100x evaluation of Split It. But it's just two totally different things. But that's what, to be honest, that's what we thought about. That's what I thought about.
Right. I think you and I think the what maybe some people didn't see was the ability for BNPL to be not just a payment option, but to be the payment option in the sense that the payment brand, I think that's different. Like you said, like Visa and MasterCard both have, buy now, pay later type functionality built into their platforms. But you don't, as a customer, Visa is not positioned that I can go to Visa and decide to do that, right? But
correct.
Affirm is actually positioning itself, as is Klarna, as is Afterpay, as my preferred shopping app when I go to the market to go buy something. And so whether it's buy now, pay later, or it's buy now, I think a couple of the firms launched buy now buttons this year. We were joking about that in the office. Like they launched a buy now button, it's just like, it's actually just a buy now. It's just a button to buy something, but it is novel in the sense that it was like, I can make an immediate purchase. I don't have to necessarily split them up. And what that does psychologically and what that does in its positioning is these companies are saying, when you go shopping, start with me, start with Affirm. I've got relationships with with Amazon now. I've got relationships with another few brands I've locked up. And so when you go shopping, consider me first, even if you're going to buy something and not finance it over 4 payments.
Yeah. I mean, it's pretty crazy what they've been able to do. And they're basically becoming an issuing bank, as crazy as it sounds. Like that's what they're basically doing, except they're being the issuing bank and the rails and everything. And they're just looping it all into one so that they can just circumvent the card networks, which is,
this may be one of the big plays. Yeah.
Crazy. Absolutely crazy.
End around.
Like
yeah.
Yeah. Really interesting. And who knows what's going to happen. I think you just start to get into especially with, people which is something we've been speaking about for a while, with people not loving credit cards as much anymore, moving towards debit a little bit more, being able to do rewards with debit, which is something that wasn't able to be done in the past. It could be really interesting what happens, over the next couple of years with what buy now, pay later, which is credit card. It's creating more credit debt. Let's be real here.
This is true. And as we were talking
totally
about
different.
In the beginning of the show, it is people are still falling into the same debt traps as whether they use BNPL
Correct.
or whether they use regular credit card. I think it was marketed initially as sort of a better solution for credit, and it may be ultimately, but it is definitely being used. It is creating more debt in the market.
Yeah.
Anyway, I think it'll be interesting to see. Also, I saw over last week, DoorDash launched a DoorDash Capital. All these platforms, these marketplaces are launching their own form of financing as well. And so, I'm just curious, like 5 years, 10 years now, if we're having these same conversations, like who are we talking to as the major lenders in the space? It may or may not be centralized in the sense that of a financial institution. It might be an embedded brand that's doing a lot of that underwriting.
Zach, DeFi is going to take over the world. The people are going to be the major lenders. Come on, man.
Okay. So this is something we'll save for another conversation, Josh.
Next time. There we go.
But I do want to talk about that because we actually are launching, I mentioned to you, we're launching a conference later this year in May called Bank Chain, which will be the combination. It's a hybrid finance of bringing DeFi together with centralized incumbent the financial industry. There is a place for that. And I actually do believe in that. And I think that's something we can talk about at another time.
Absolutely. It's going to be, DeFi is super powerful, and there's going to be.
I know you're a big believer.
I'm a big believer in DeFi, and I'm also, like you said, I agree with you. I'm a big believer that there can be a way for traditional finance and DeFi to be able to work with each other. And I think that it's really interesting, and it's like you've said, you and I have spoken many times, is possibly one of the most transformative tech that we're going to see in our lifetime. The idea of DeFi, and it'll be interesting to see what happens, once the regulators get involved, once the dust settles, once things start getting real, what it exactly turns into.
Josh, man, it's great to be back behind the Zoom screen here, talking to you again, recording our podcast.
Oh yeah.
Appreciate that. And thank you guys all for tuning in to the Challengers podcast.
Thanks everybody. And Zach, always good. See you next time.